The Property Deconstructed podcast and videocast as well with Mark Errichiello from Master Advocates, a very special guest. This is the third part in this series with Michael Siu. He's really dropping some nuggets of gold for our listeners there, Mark.
Yes, very kindly. Michael Siu, director of his own mortgage choice, mortgage lender, as well as plenty of years of experience and background in accounting and law, as well as retirement and superannuation specialist in his past career. So Michael's put together some great slides and a good effort in breaking down and explaining loan structuring and benefits and ways to pay off your loan faster.
Yes.
And this is where we left off in the last episode, Michael. So welcome back.
Smarter, not harder. Faster and smarter is what we're doing.
Right.
Okay, Michael, we're back. So where did we leave you last time? We're talking about now smart loan structuring to build your wealth on your presentation, yeah?
Yeah, that's right. So last time we were talking about, the strategy to buy an investment property, right? But actually, how do you actually physically buy that investment property? Where do you get the funds from? So that's what we want to talk about today. Okay, and so it's essentially smart loan structuring to build your wealth, continuing on that theme about working smarter, not harder. So this time it's around smart loan structuring. So turn to the slide here, step one. So
yes.
It's accessing the equity in your own home. So if you remember back to the example that we had before, let's say your home is valued at $1.3 million. You had a home loan on that property for $800,000. And I've put here to emphasize that it's non-deductible. That interest on that property, on that home loan is non-deductible. Plus then as part of the loan structure, you'll have an offset account, right?
Because this is your owner-occupied home that you've started
with. Yeah, owner-occupied home. Yeah, exactly. That's right. So what I'd suggest here now, the next, as part of this, and it's what I called a deposit loan, okay? And that deposit loan, so it's a new loan that's secured against that home of 1.3 million. And I'm saying here for that loan to be up to $240,000. And as the name suggests, that will be used as the deposit for the purchase of that investment property that we spoke about in an earlier episode, okay?
Yes.
And the funds there would be put into that offset account.
Right.
So that way you're not being charged any interest until you use that money, until you've found a property. Now, where did I come up with the $240,000 amount, right? Well, when you add the 800 to 240, 800 to the 240, combine those two together, divide that by the 1.3 million, right? That gives you an 80% LVR. Okay, so you're borrowing the maximum possible to get to that 80% LVR. The 80% LVR is the magic mark where you avoid lender's mortgage insurance.
Yes, and that's your loan to value ratio of the property worth.
Right.
Correct. Yeah, that's it, 100%. And so this deposit loan, as I said, you'd set this up before you purchased the property and it's secured against the home of that's valued at 1.3 million, and you use it to fund the 20% deposit on the new investment property. Okay, so that's step one. So step two, we're setting up the new investment loan. So this diagram here that you can see, that's what we brought across from the previous slide where we've got that deposit loan set up. Okay, you find that investment property, and there was that $700,000 investment property. Then what you do is you use that deposit loan, right, and paying a 20% deposit. And remember saying 20% to avoid that lender's mortgage insurance. And that's $140,000. And you would have gotten pre-approval on the investment loan that's secured against that investment property. That's this investment loan. That's for $560,000. And that represents 80% LVR on the $700,000 investment property. So what you've done here, and you'll notice the magic in this is that you haven't had to contribute a single cent to the purchase. The purchase price has all been covered by the deposit loan and the new investment loan, and including the stamp duty.
Right.
Now the lender that you use could be different doesn't have to be the same one that you use for your home loan that you live in, for the property that you live in. Can be a different lender because it's a different loan, this one here for the investment loan. And you might choose to do that because like that lender could be offering you cash back. They could be offering a really sharp rate that the original home lender couldn't match. So that's why you might do that. It gives you flexibility, basically.
And that's even if that principal home's being used as the security. There are lenders out there that will structure it with holding loans with separate banks.
Yeah, that's right. So this one can be a different lender to this one. This deposit loan would be the same lender
Yes.
as that home loan here. But this one, you could be the same or different. It just gives you that flexibility.
Yeah, yeah. Flexibility is good, isn't it? Because you have more options and you can make it happen quicker and better.
Yeah,
Yeah,
and there are
exactly.
still good value assets when you're looking at the investment. Under 700,000, market will always continue to rise with population growth as well. But there are still some great assets that will get that growth and a decent return to contribute to the loan as well.
Okay.
But we can get back to the market and state of the market at another time.
Yes.
I'll let Michael continue.
Right. No, that's interesting. So yeah, okay. So from your point of view, you're saying make sure that asset that you purchase has that is the right choice.
The growth potential,
Yes.
and then the yield, and how does it perform in the rental market as well,
right.
and what you need to contribute
Yes.
capital wise to keep that property maintained. But there are still definitely great assets out there, especially in parts of Victoria and parts of other states as well.
Right. As I say, that's the fun bit too. You find somewhere you love and you make sure it ticks all those boxes. And also, there's a lot there, but having the equity, I noticed in your home too. You've got to have that too. You've got to have a bit of equity in there to leverage off as well.
Home,
in the principal home. So that's something also that you look at. Surely, Michael, when people come and see you, that's one of the key ingredients to this magic formula you're talking to us about.
Oh yeah, 100%. Yeah, and so that's that making sure that the home that you've purchased also has those characteristics that Mark's been talking about. It's a high quality home that will grow over time.
Yes.
In value. And the other part is that equity also comes from the fact that you are paying down that principal, whether it be through the minimum repayments each month that are required, or you are just chipping away at it by putting extra payments into it. But it's having that equity there that gives you those options and flexibility to be able to grow your wealth.
Some key takeaways. I like this. Should we do that, Mark?
Yeah,
so before
certainly.
our viewers, just to sort of sum up, I can see in your presentation here, key takeaways there for us, please, Michael.
Yeah, okay, sure. No, so the key takeaways, well, as the theme that we've been using throughout the series is work smarter, not harder. And that's because if you remember, in terms of the cost associated with the investment property, you're only contributing 20%, whereas 80% of it's been contributed by someone else. And if you remember with the purchase of it, the way that we structured the loan, you're not contributing a cent. It's all by the lender.
And that's the purchase of your investment as well. So it's and it all does come back to the right property selection also. And then even with your principal home, what we were touching on, some people may not look at other aspects. If they're driving and they're willing to travel for the principal home, you should still take into account the broader market for resale and growth. Is it near good infrastructure and amenities if you can afford that? Because all of that will contribute to it performing well, even as an investment later down the track. If you relocated or resold it.
Yes. These are really, I'm thinking about from my point of view, once we start talking to people about this wonderful series, one of the headlines would be right to say that I've written down here, the secrets of property investors, because somebody like me who's not in that world think, how do they do it? And this is how people are doing it. They're building wealth through property by understanding this sort of stuff there, boys, yeah? These are the secrets.
Yeah, 100%. And the beauty of what we've shown as well is that it's not just a one-off. This is that thing about where you've got the model right, then over time, as you build equity in each property, you rinse and repeat and you do the same thing.
Gee. Yes, without the procrastination, because time is money as well, and there's we need to highlight there are a lot of people in hardship at the moment with cost of living and looking for that opportunity, suffering in the restricted rental market. So we're seeing stronger clearance rates, lower stock available, rising population, high taxes, all of that.
Yes.
And now, we've had one rate cut this year, some reprieve after so many rate hikes. And Michael, in May, the next decision, what's your guess, your professional outlook?
Yeah, I'm thinking given all the volatility that's happening in the marketplace, I think the Reserve Bank's probably more likely to pull the trigger for at least a quarter.
Another cut.
Yeah, that's right. I think given all the volatility in the markets over the last few weeks, I think back when they announced that they were holding firm last time around in April, I think there was probably of a mindset that they were going to be pretty measured in their approach.
Yes.
But I think given the pace of change over the last
Yeah,
few weeks,
yeah.
I've got a sense that maybe they may decide that to be more prudent would
Yes.
actually cut rates.
That's
Yeah.
right. Well, I heard that's at the time of recording, it's April 2025, early April now. We're talking about the RBA's meeting in May.
After the federal election.
That's right, May 3 on that Saturday, yeah.
May 3 is the federal election. I think May 20 is the next meeting.
Yeah,
is that
yeah.
correct?
Well,
Yeah.
I heard
The RBA
today on the
meeting.
radio that there's somebody else just saying that it looks like the RBA, because of this volatile situation in the world market, I guess it's the trade war and all that sort of stuff, that, interest rates may come down really sharp now, guys,
Yeah.
so they might start getting the scissors out.
Yeah, and residential property is our largest asset class here in Australia. And the sentiment, as soon as there was a little bit of relief with rate cuts and costs there, relieving some pressure on the cost of living, repayments, there was immediate sentiment to start acting rather than going back to that word procrastinating, because of the fear that things might be stimulated and some competition and some growth. So especially if there's another rate cut, I'd see that confidence, that sentiment in the market, even some investors coming back to states like Victoria from interstate.
Do you reckon our Prime Minister's sitting at home right now thinking, I wish that Reserve Bank meeting was before the election? Yeah. It'd be nice, wouldn't it, to get the headline with the interest rates coming down and then I'm walking into the polling booth. Yeah. Anyway, it's not going to happen. Were you always into this sort of thing, Michael, just sort of clever with numbers and finance and working these sorts of things out? Is that you as a boy?
Yeah, I have to admit, when I was younger, I was probably better at the numbers, maths and so forth, than any other sort of subject. And so I was sort of just naturally drawn to it, whether it be property or shares, equities and so forth. So I pretty much love investing, which is why, and then, with the way the rules are, the laws are, it just seems to be like a no-brainer to be able to invest in property.
Yeah, right.
I've always enjoyed discussions with Michael over time, and really it shows in the effort that you put together the slides to break it down and explain it rather than just speaking to us. It was really, really well thought out.
Are you happy for our viewers and listeners to maybe contact you, Michael? We'll put your stuff on the screen there, your email address, your phone number, that sort of stuff?
Yeah, absolutely.
That'll come with the slide
the
deck.
Details on the screen there, so phone number and then their email address. So happy to have a chat, even if it is just a casual sort of chat to act as a sounding board or bounce ideas off me. Happy to do that because I love talking about property, love talking about investments generally.
Nice.
Fantastic. Yeah, always great advice, and thanks for sharing, Michael. And yes, please, if listeners are looking at investing in property or buying property and stepping out of the rental market, everyone needs shelter. Always a great idea to get some professional advice and get an A-team around you, not just property real estate professionals. You need to get the ducks in a row first. So starting with your mortgage lending professionals, get a solicitor in line, accountant, maybe financial planner. All cost money, but the proper planning will give a better chance of success.
Isn't it, really? So you can help people with that, Mark, if they come to you, so there's getting the right team around them?
Point them in the right direction of different professionals. Certainly, if they don't have their own, or we work together with other people that are already surrounding them and helping them. But no, it was great listening and great having another chat with you and meeting up, Michael.
Yeah, no, thanks for having me on, Mark and Pat.
Been an absolute pleasure.
Great session.
Michael Siu, our special guest here on Property Deconstructed. Thank you, everybody. Thanks for being here.